At some point, every marketing agency owner stops and thinks, hey, is my business optimally structured? Should I be an LLC or S corporation? Or they think that because everybody nowadays is an S corporation, that they should be one as well. However, the election has become almost like a trend for small business owners to the point that people just jump into the S corporation without realizing that they are conflating a tax treatment with a legal business entity and without even understanding the compliance implications that you now have to deal with moving forward, assuming you even qualify to elect for the status in the first place. So in this video, we're going to exactly define what an S corporation is, the compliance requirements, and when it actually makes sense, not only for agencies, but for other service businesses as well. I'm Jose Cardenas, CPA and enrolled agent at Westfront Tax and Accounting. We provide business accounting, bookkeeping, and tax services to service businesses with a specialization in creative agencies. The first thing to understand is that an S corporation is not a legal entity, okay? Legal business entities is your limited liability company, your LLC, for example. We also have corporations, partnerships, we also have limited partnerships, and also limited liability partnerships. Specifically, the term S corporation is a tax treatment, okay? It has nothing to do with how your LLC protects your personal assets if your clients choose to come after you someday. And what this means is that your legal business entity could be an LLC or a corporation, be taxed in its default way, and then subsequently, or when you open the entity, you have the option to elect out of the default tax treatment for the S corporation tax treatment. Where most people trip is when they go ahead and they create an LLC, okay? Maybe by themselves, maybe with their friends, maybe with their siblings, maybe with other business partners, only to get confused with the fact that, well, the default tax treatment changes in each of these circumstances. And what I mean by that, and look, this is the simplest way to think of an LLC for tax purposes. Think of it as a tax chameleon, okay? So regardless of you owning it by yourself or with other people, yes, you'll still enjoy the limited liability protection of your personal assets, yet depending on the ownership structure for tax purposes, that LLC will automatically, without you doing anything, be treated as either a disregarded entity if you own it by yourself or as a partnership if you own it with other people. Now, because of the fact that we all have to pay self-employment tax of 15.3% on top of federal and state income tax from our active 1099 income or business profits, most people, rightfully so, jump and file for an S election for the LLC because, well, with the elections, your profit wouldn't be subject to the self-employment tax, but they do so without even knowing if they qualify for the election in the first place, okay? You have to make sure, number one, that all owners are individuals, estates, or trusts. So you can't have partnerships, no corporations either, as owners of that LLC. Second, owners must be residents of the United States, okay? Number three, you cannot have more than 100 owners, but keep in mind, family members are counted as one. And fourth, well, you can only have one class of stock, which for the most part, that should not be an issue at all. If you qualify, then you can make the election by filing Form 2553 with the IRS. But keep in mind that you are expected to run payroll for yourself because you become an owner and an employee at the same time of your business. This is because, well, since your profits are no longer subject to the self-employment tax, the IRS wants you to give yourself a market-based salary based on what you do in the day-to-day of operations because honestly, they decided that you skipping the tax on all profits was too much. So they want you to still pay something that is objectively based on what you would pay somebody else to do what you do in the business. Although in many cases, it does make sense to pull the trigger on an S corporation tax election, it doesn't more often than what you think. So we'll go over the three of the most common situations that I often see. And number one situation is when, well, people come to me, they already filed for the election, but the market-based salary for what they do in the business, considering the totality of the circumstances and where they're heading, leaves very little to no benefit in making the election. So if you, for example, have a large agency of say 10, 30 people, you're the CEO, you're making seven figures, very hard to substantiate a below six-figure salary to an auditor with a straight face. Also, if you're a doctor, the same. I don't think there's a doctor out there that makes less than 6 figures a year. So in this kind of situation, people either end up giving themselves a proper salary and get no benefit from the election, or underpay themselves and are now at risk with the IRS. And also, it distorts your financials for any potential buyers and investors when they look at your numbers. The second scenario is when the income you're making is not even subject to the self-employment tax in the first place, which is income from businesses or activities you're not materially participating in, you're not actively involved, or rental income from rental properties. In these instances, no benefit whatsoever in making the election. The third situation where making an S corporation tax election may not make sense for you is when there's a lot of debt involved in the day-to-day of operations. Because under the S corporation treatment, third-party debt inside the business does not increase your shareholder basis, unlike for partnerships, for example. And what I mean by that is that if the business borrows money and you end up withdrawing some of that cash for yourself or for other purposes, you could trigger a taxable gain that you would only know about come tax time on your personal tax return. This is why S corporations tend to work better for service businesses, because typically there isn't much debt required before you perform, before you get paid for your services. Whereas non-service businesses, they do often have to rely on credit cards or other financing to operate. So if any of these three instances don't apply to you and your business is making, or at least on track to make, no less than 6 figures in profits, not revenue, then yes, electing the S corporation status for your LLC could save you about $10,000 or more a year, even after the additional compliance responsibilities that come with it. And by that, I mean payroll tax filings, payroll payments, proper bookkeeping inclusive of a proper clean balance sheet, and the extra corporate return that you would have to file every year. The main takeaway of this video is that an LLC protects you, and an S corporation could save you money given the proper circumstances and if the numbers make sense, of course. And that's all I got for you today. So hopefully you found this video insightful. If you did, make sure you smash the like button for me, subscribe, follow the channel. And with that said, I'll see you on the next one.